Preparing for a finance manager at SPAR interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a finance manager at SPAR? I want this role because SPAR combines fast-moving retail operations with meaningful commercial complexity. Finance can directly influence sales, gross margin, waste, labor, inventory, and cash across stores and distribution activities. My experience in budgeting, variance analysis, controls, and stakeholder partnering would help operational leaders make better decisions quickly. I also value SPAR's entrepreneurial and locally responsive model, where finance must be both rigorous and practical rather than simply reporting historical results. While answering, connect your motivation to SPAR's grocery retail model, store and distribution economics, commercial finance partnering, operational scale, customer focus, and your ability to turn financial analysis into practical decisions that improve performance. Question 2. What are the most important financial performance drivers in grocery retail? The main drivers are sales volume, average basket value, product mix, gross margin, promotional effectiveness, waste, shrinkage, labor productivity, occupancy, and supply chain costs. I would separate like-for-like performance from new store growth and investigate whether margin movement reflects pricing, supplier costs, mix, or markdowns. In grocery, availability matters too. A stockout can reduce sales and damage loyalty. I would therefore connect financial results with operational KPIs rather than analyzing profit in isolation. Make sure to cover like-for-like sales, traffic, basket size, gross margin, promotions, waste, shrinkage, labor, occupancy, supply chain costs, inventory availability, working capital, and the distinction between controllable and external drivers. Question 3. How would you prepare a monthly management pack for SPAR leadership? I would begin by validating the close, reconciliations, accruals, and key data interfaces. The pack would show sales, margin, operating costs, EBITDA, cash, working capital, and store or region performance against budget, forecast, and prior year. I would highlight material variances, explain operational causes, and distinguish one-off items from recurring trends. Each issue should have an owner and action date. My objective is a concise pack that supports decisions, not a long collection of unexplained numbers. In your answer, talk about accurate close procedures, concise dashboards, actual versus budget and prior year analysis, like-for-like metrics, store-level trends, root causes, forecasts, risks, actions, and clear ownership of follow-up items. Question 4. How would you investigate a gross margin decline at a SPAR store or region? I would build a margin bridge separating sales mix, purchase prices, selling prices, promotions, markdowns, waste, shrinkage, and supplier income. I would compare affected categories, stores, and weeks against budget and prior year, then test whether the movement is genuine or caused by timing or coding. For example, a small margin decline might reflect heavier promotions, while a larger unexplained gap could indicate stock loss or rebate accrual problems. I would finish with corrective actions and monitoring. Be sure to mention price and cost changes, product mix, promotions, markdowns, waste, stock losses, supplier rebates, data quality, timing effects, comparison periods, and a bridge from reported margin to operational root cause. Question 5. What is your approach to budgeting and forecasting in a multi-site retail environment? I prefer a driver-based process rather than simply increasing last year's numbers. I would forecast sales using traffic, basket size, calendar effects, local trends, and store maturity, then model margin by category and costs through labor hours, rent, utilities, logistics, and inflation. I would include base, upside, and downside scenarios, challenge assumptions with operational managers, and refresh the forecast monthly. This creates a realistic view of performance and highlights risks early enough to act. Focus on driver-based planning, store-level assumptions, sales and margin trends, labor and occupancy costs, new openings, seasonality, scenario analysis, challenge sessions, ownership, and frequent forecast updates using current operational data. Question 6. How would you manage inventory accounting and stock controls in a grocery business? I would ensure goods received, sales, transfers, returns, markdowns, waste, and stock counts are recorded promptly and accurately. Inventory should be reconciled between systems and the general ledger, with clear procedures for cutoff and valuation. Perishable goods require particular attention to expiry, markdowns, and waste. I would review count variances and investigate unusual shrinkage by store or category. Strong controls include segregation of duties, authorization limits, exception reports, and periodic independent counts. Cover perpetual records, stock counts, goods received, cut-off, valuation, markdowns, expiry, waste, shrinkage, reconciliation, segregation of duties, exception reporting, and collaboration with stores, warehouses, and supply chain teams. Question 7. Tell me about a time you improved a finance process. In a previous role, month-end reporting relied on spreadsheets from several teams and took 8 working days. I mapped the process, eliminated duplicate inputs, standardized account mappings, and introduced a controlled reporting template with automated checks. I worked with operations and IT to test the changes, trained users, and documented ownership. The close fell to 5 days, review errors decreased, and managers received earlier insight. I would apply the same disciplined, stakeholder-led approach at SPAR. In your answer, use a structured example covering the original problem, business impact, root cause, stakeholders, redesign, automation or standardization, implementation, measurable result, and how you embedded the improvement sustainably. Question 8. How would you manage cash flow and working capital at SPAR? I would build a rolling cash forecast supported by sales, inventory purchases, supplier terms, payroll, tax, rent, capital expenditure, and financing assumptions. In retail, inventory and payables are especially important, so I would monitor days, aged balances, stock cover, and supplier payment compliance. I would also review store cash handling and banking reconciliations. If liquidity tightened, I would prioritize essential purchases and CapEx, accelerate collections where relevant, and communicate scenarios early to leadership. Mention daily cash visibility, supplier payment terms, inventory days, receivables, payables, seasonality, capital expenditure, cash forecasting, liquidity risks, store cash controls, and balancing supplier relationships with financial discipline. Question 9. How do you ensure month-end close is accurate and completed on time? I use a close calendar with named owners, deadlines, dependencies, and review points. Key controls include bank, inventory, supplier, payroll, tax, intercompany, and fixed asset reconciliations, together with proper accruals, prepayments, and cutoff testing. I prioritize high-risk areas early and use exception reports to focus review effort. Any late or unusual item is escalated promptly. After close, I review recurring issues and improve the timetable, documentation, or system control rather than accepting avoidable delays. Be sure to discuss a documented close calendar, responsibilities, reconciliations, accruals, prepayments, cutoff, intercompany balances, review controls, materiality, system interfaces, escalation, and continuous improvement after every close. Question 10. How would you evaluate the financial performance of a new SPAR store? I would compare actual performance with the approved business case across sales ramp-up, gross margin, labor, occupancy, logistics, waste, CapEx, EBITDA, and cash generation. I would separate temporary opening costs from recurring economics and assess whether nearby stores experienced cannibalization. Break-even timing, payback, and downside sensitivity are critical, especially if sales are below plan. I would then identify operational actions, such as staffing or range changes, and update the investment model using actual evidence. Focus on investment appraisal, sales ramp-up, gross margin, labor, rent, logistics, capex, cannibalization, local demographics, break-even timing, cash payback, sensitivity analysis, and post-opening comparison with the approved business case. Question 11. What controls would you prioritize over store cash, till transactions, and refunds? I would prioritize restricted till access, individual user credentials, documented cash counts, prompt banking, and daily reconciliation between tills, card settlements, and the ledger. Refunds, voids, discounts, and manual price overrides should have appropriate approval and exception reporting. Surprise cash checks can test whether procedures operate in practice. I would investigate unusual patterns by employee, shift, or store, while avoiding assumptions before evidence is gathered. Clear escalation and segregation of duties reduce both error and fraud risk. In your answer, cover segregation of duties, till access, cash counts, banking, refund approvals, voids, discounts, electronic payments, surprise checks, reconciliations, exception analytics, fraud indicators, and proportionate escalation procedures. Question 12. How would you explain a complex financial issue to a non-finance store manager? I would start with the operational consequence, not accounting terminology. For example, I might explain that waste increased by £8,000 because ordering exceeded demand in several categories, reducing the store's profit by that amount. I would use a simple trend or category breakdown, ask the manager for context, and agree practical actions such as revised ordering thresholds and daily review. I would confirm the next reporting date and measure whether the action improved both waste and availability. Make sure to cover plain language, operational relevance, visual evidence, one clear message, quantified impact, listening, practical actions, confirmation of understanding, and avoiding unnecessary accounting terminology or blame. Question 13. How do you handle disagreement with an operational stakeholder about financial results? I would first listen carefully and understand why the stakeholder disputes the result. Then I would validate the data, reconcile the relevant transactions, and separate factual errors from differences in interpretation. I would present the evidence transparently and connect it to the shared objective, such as protecting store profitability without reducing availability. If the result were wrong, I would correct it quickly. If it were right, I would agree an action plan and follow up rather than turning the discussion into a personal disagreement. Discuss maintaining credibility, checking data, understanding the stakeholder's perspective, separating facts from assumptions, using reconciled evidence, focusing on shared objectives, agreeing actions, and escalating only when necessary. Question 14. What would you include in a business case for a major technology or automation investment? I would define the problem, affected processes, strategic benefit, and measurable outcomes before discussing technology. The case would include implementation and ongoing costs, savings, revenue or margin benefits, working capital effects, risks, dependencies, training, and control requirements. I would calculate payback and NPV using realistic assumptions, then test downside scenarios. Approval should include milestones and benefit owners. After implementation, I would compare actual benefits with the case and explain any shortfall promptly. Cover strategic rationale, current pain points, quantified benefits, implementation cost, ongoing cost, risks, dependencies, adoption, control implications, payback, NPV, sensitivity analysis, milestones, and post-implementation benefits tracking. Question 15. How would you prepare for an external audit or internal controls review? I would begin with the prior year findings, risk assessment, audit timetable, and evidence request list. I would ensure reconciliations, inventory documentation, contracts, journals, approvals, and control evidence are complete, traceable, and reviewed before submission. For store and inventory areas, I would coordinate count attendance and investigate discrepancies promptly. I would maintain an issues log with owners and deadlines, communicate openly with auditors, and challenge unsupported conclusions professionally. Findings should lead to documented remediation, not merely explanations. Be sure to mention risk assessment, evidence organization, reconciliations, control narratives, owner confirmations, inventory observations, audit requests, issue tracking, timely communication, remediation, and maintaining independence and professional skepticism. Question 16. How would you assess the financial impact of a supplier price increase? I would quantify the impact by supplier, product, volume, and timing, then model gross margin under different retail price responses. I would consider customer price sensitivity, competitor pricing, promotional commitments, private label alternatives, and possible supplier negotiations. A 10p cost increase on 1 million units has a £100,000 gross profit impact before mitigation, so scale matters. I would present options, including price changes, range substitution, pack size changes, or promotional redesign, with both margin and volume implications. Focus on volume, affected categories, current margins, selling price elasticity, competitor pricing, promotional plans, supplier negotiations, substitution, customer impact, timing, scenarios, and protecting profit without undermining sales or market position. Question 17. How do you prioritize competing deadlines during a busy month-end period? I prioritize by financial risk, materiality, dependency, deadline, and business impact. Statutory reporting, cash, inventory, payroll, and controls receive early attention, while lower risk analysis can follow. I maintain a visible task plan, delegate clearly, and communicate conflicts before deadlines are missed. If necessary, I agree a minimum viable output and a later enhancement with stakeholders. Speed must not compromise control quality, so I retain review evidence and escalate capacity constraints rather than hiding them. In your answer, discuss materiality, risk, dependencies, statutory deadlines, business impact, delegation, early communication, escalation, quality safeguards, and maintaining a visible task plan rather than reacting to whoever asks most loudly. Question 18. What would you do if a store repeatedly missed budget despite strong sales growth? Strong sales do not automatically mean strong profit, so I would examine margin rate, product mix, promotions, waste, shrinkage, labor productivity, occupancy, and logistics costs. I would compare the store with similar locations and bridge actual results to budget, identifying whether assumptions were unrealistic or execution was weak. After discussing findings with the manager, I would agree a focused recovery plan, such as reducing waste or improving schedules, with weekly measures and clear accountability. Mention separating sales from profit, reviewing margin, promotions, mix, waste, shrinkage, labor, rent, logistics, budget assumptions, controllability, store benchmarking, root cause discussions, and a measurable recovery plan. Question 19. Which KPIs would you use to monitor SPAR's retail operations? I would use a balanced scorecard. Financial measures include like-for-like sales, gross margin, EBITDA, cost ratios, cash conversion, and working capital days. Operational measures include transactions, basket size, availability, waste, shrinkage, labor productivity, stock cover, supplier service levels, and queue or service indicators where available. Customer measures help explain future performance. I would avoid excessive KPIs and focus on metrics with owners, reliable definitions, regular trend analysis, and a clear link to decisions. Cover financial and operational measures including like-for-like sales, transactions, basket size, gross margin, waste, shrinkage, availability, labor productivity, inventory days, supplier service, EBITDA, cash conversion, and customer indicators. Question 20. What would be your priorities in your first 90 days as SPAR Finance Manager? In the first 30 days, I would learn the business model, visit stores or distribution operations, meet finance and operational stakeholders, and understand reporting, systems, and key risks. By 60 days, I would validate major reconciliations, performance drivers, forecast assumptions, and control gaps, while identifying quick wins. By 90 days, I would present a prioritized roadmap covering reporting, process efficiency, commercial insight, and team development. I would build credibility through accurate delivery and practical improvements. Be sure to mention listening to stakeholders, understanding the operating model, reviewing reporting and controls, validating key data, identifying quick wins, learning systems, assessing team capability, and creating a prioritized improvement roadmap. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.